So if you are thinking about buying a home, financing is probably one of the biggest parts of the decision-making process, especially in the beginning. And it does set the terms for your payments for the entirety of the time that you own the home. So rates, down payments, credit, monthly payments, loan options. And then not only that, but like what happens if you buy in Middlesex County versus Mercer County versus Somerset County versus Burlington County? The loans change county by county, almost town by town. So there's a lot of confusion around how mortgages work. So today we're breaking down what buyers need to understand before they start shopping. It's not necessarily a policy and property episode, but it's a process episode of the Wilton Report explaining the mortgage process and everything you need to know locally in the Quad County area to understand the mortgage market. So welcome back to the Wilton Report. I'm Josh Wilton. I co-own and run the #1 boutique real estate company here in Central New Jersey, Queenston Realty. And we do work with buyers and sellers every day, and we use that knowledge to help you make smarter decisions. Joining me tonight is Jonathan Brunone. He is a loan officer. He's also director of account management and growth strategies at Mortgage Now. So let's welcome Jonathan Brunone to the Wilton Report. Hello, Mr. Brunone.
Hey, Josh. Can you hear me?
We can hear you fine.
Okay.
So welcome aboard.
Let me try one thing. Sorry, I think we're having some technical difficulties.
I can hear you. I heard you with your earbuds in. So I would keep your earbuds in. All right. What we will do is remove Jonathan from the studio. And I'm going to tell you that one joke I know. So there's a German guy and Irish. No, I'm only kidding. They walk into a bar. All right. So we are going to give Jonathan a minute to reconnect. He obviously just had an internet outage. But again, tonight on the Wilton Report, we are going to be talking about mortgages. So one of the interesting things I find is that Princeton is about 2 miles from Somerset County. Princeton is 2 miles from Middlesex County, not even. It's more like 1.5 miles. It's probably less than 7 to 10 miles to the western tip of Monmouth County. And then you have Burlington County just to the southward of us, not by much. So one of the things that matters is like the loan limits change by county. So if you're getting a conventional or jumbo loan in Mercer County, that changes the numbers. From Middlesex County, it changes to Somerset County. The FHA loan limits change county by county. So one of the things we will talk about once young Jonathan gets reconnected to the account is all the different loan limits. This poor kid, he's like getting killed by technology right now. So we're working on connecting Jonathan Brunone. So, all right, well, I'm just going to keep talking about the real estate market in general. So right now we are in an interesting time of year in the real estate market. It is the last 2 weeks of August. So what does that mean? It means anybody with a kid is otherwise occupied. There's no camps. They're not in school yet. Grade school, middle school, high school. College kids are heading off to college. So we are in what we call the summer doldrums before the September surge. And I think we have Jonathan Brunone back live with us. So Jonathan, are you there?
Yeah, I'm here. Can you hear me?
We can hear you. Okay. So we're going to get going with the episode.
Yeah.
So let's do a quick background about you, right? So How did you get into the mortgage industry?
Okay. The quick version. So
yeah,
I got my real estate license in 2016. Prior to that, I was in staffing and recruiting. Loved it. Real estate was great. And I ended up getting a random job offer a few years later at PHH Mortgage for corporate recruiting, which I enjoy, and worked with the different business units. I was still able to do real estate. And fast forward to 2021, I connected with Jim Marchese, and the question was, hey, would you want to recruit for a smaller mortgage company? I said yes, and here I am.
Here you are.
Different job capacity, but yeah,
that's right. So I've been in the real estate business for 20 years, right? And I've seen mortgage loan officers come and I've seen them go, just like brokers, everything. And just a quick anecdote about working with Jonathan, because he's our preferred lender at the Wilton Group, my team at Queenston Realty. I actually had a customer call me once and go, Josh, what's up with Jonathan? And I was like, what? I'm like, oh my God, thinking like something went wrong. I said, I don't know. What's happening? He goes, well, he treats me so well. I'm like, I was very taken aback. I think I told you this, right?
Yeah, I was very taken aback. I remember.
He goes, he treats me like the most important client he's ever had. And I know I'm not like the biggest loan he's working on, whatever. And I'm like, well, isn't that the point? And he was like, he couldn't understand the level of service that you're giving. So let's talk about buyers, right? So what kind of borrowers do you guys generally work with? Because again, we do a lot of work here in Mercer County. I know you do a lot of work here in Mercer County, but we also do Middlesex, Somerset, Burlington, Monmouth.
Sure.
Right. So what kind of buyers and borrowers are you typically working with on a day-to-day basis?
Yeah. So we work with the traditional, borrowers, the conventional FHA, VA, but we also specialize in, self-employed borrowers, complex alternative financing borrowers.
So let's stop right there for a second. Right.
Okay,
so
sure.
Let's explain the difference between self-employed borrowers and a W-2 borrower. So I'm a W-2 employee. I work at Bristol Myers Squibb. I'm an employee. I get a paycheck every 2 weeks or whatever.
Sure.
Banks actually prefer them to self-employed business owners. Is that a fair statement?
Yeah. Yes.
Right. So you can have a self-employed business person that makes a lot of money.
Yeah.
And the lending to that particular person is very different. Do you want to explain why that is?
So with self-employed borrowers, which that's one of our specialties, it's definitely different because, first off, when you're calculating income, it's not as simple as, W-2, just look at the hours, it's easier to calculate that. Self-employed, they can have multiple businesses. Some have a lot of different businesses, and just calculating income, seeing what is, what they're using to write off, how consistent their income is
year over year.
There's a lot business. There's a lot. Yeah,
there's a lot that goes into it. So Mortgage Now is an interesting company because they actually like that kind of product, whereas like a traditional bank like a Wells Fargo maybe would shy away from it.
Yes.
So let's talk about the first thing that everybody likes to talk about, because everybody thinks I call everybody the armchair generals, right? Yeah. Let's talk about interest rates. Okay.
Sure. Okay.
And I know every loan officer likes to prognosticate about interest rates. They like to pretend they're all experts. They have zero to do with how rates are determined. So let's talk on a 10,000 foot level. What does determine mortgage rates?
Okay. So basically it's the overall economy and the financial markets. I mean, you have, inflation, the job market. I mean, if you want to get technical, like treasury, mortgage, bond yields, economic growth, investor expectations, like all those play a role.
Employment,
there's a lot,
all of it.
Yep.
Right.
Yep.
Oil,
job market. Yep.
Inflation. There's so many.
Yes.
Mini and micro, max, and macro determining factors on interest rates.
Yep.
Right. It's not hard to predict, but it's not easy to predict at the same time. Right.
Correct.
So let's talk about how directly mortgage rates are tied to the Federal Reserve. We'll just kind of do a 10,000 foot view of rates.
Sure. So the Fed, they control the short-term rates, not mortgage rates. I mean, they have influence on it, but they don't. The mortgage rates are driven by the bond market and inflation expectations. So the Fed has indirect influence on it.
Right.
10,000 foot.
And then, that's why, and then like the Fed will lower the short-term rate, which they have a couple times since COVID,
Yeah.
right? And
Yeah.
the next day interest rates go up. Mortgage interest rates go up. And it's this repetitive thing. It's just people don't quite understand the macro. They kind of, they just want to focus on the rate that they got because they want to go to the cocktail party and say they got a better rate than their buddy or their friend, their whatever. So, okay. So if I'm a borrower, right, what are the top 4 or 5 determining factors that determine my rate?
Okay. So you have your credit score, specifically to the borrower credit score. You have your down payment. You have the loan type. The property type plays a part in it as well. I would say, loan program, loan type. And those are the things: credit score, down payment, loan type.
And not only that, but if you're an investor, you're going to pay a higher rate. Like if you're going to buy a multifamily property, you're going to pay a higher rate. Like there's all these little nuances that go into it.
Yeah.
And we're going to talk about like the county level, Mercer versus Middlesex versus Somerset and the jumbo and all the conforming. We'll talk about that later. But like, buyers are very rate sensitive, right? In most markets. Princeton's a little different. As we know, 40% of Princeton is contractually presented as cash. They can convert to a mortgage, obviously. And then you can go to Hamilton where it's like less than like 7% is cash. So Hamilton's much more rate sensitive. So if I'm a buyer, right?
Yeah.
What should I actually pay attention to when it comes to interest rates fluctuations?
So because if you pay attention to interest rates fluctuations, you're gonna go crazy. So I mean, the biggest thing for me would is pay attention to the payment, the mortgage payment. Obviously the rate, what you qualify for, is important, but I say overall the mortgage payment is probably the most important, because if the mortgage payment works, you can always refinance later on when rates do drop, whenever that is. But I would say focus on but I would say focus on the payment first, and if it works.
Yeah, and if you're a buyer and you're listening to this episode, and any loan officer says to you, marry the house, date the rate, run away from that loan officer with both feet, both hands, run as far as you can. Marry the rate, because we don't know when rates are going to go down. And I would say, just having been in this space for a long time, there's more inflationary pressure right now for rates to go up, right? We'll see what happens with employment.
Yep.
But right now there's, the last Fed meeting was a little dicey whether they were going to hold or raise, right? So there's a lot of upward pressure on rates right now. So if you're a buyer, to Jonathan's point, focus on your monthly payment. If it's a comfortable number, it should not exceed whatever percentage of your income is comfortable for you to spend. Right. Focus on that versus the day-to-day bump up and down of interest rates, because it is kind of bumpy right now, right?
It is. It's a little bit. I mean, if you look at the beginning of the year, I mean, rates have been, and actually even in last year, rates have been, I would say, hovering in like mid 6s, and then it would fluctuate a little bit, but it hasn't been. There hasn't been a ton of movement. I think the average has been generally around mid 6s.
6.5. Let's call it. I've been using 6.5 as
you're right.
For like a year and a half. I'd love to say 5.75, but I think that's quite a ways off. So let's pretend we're a buyer, right? And I was talking to somebody today, new customer, and we did the consultation, and you'll end up talking to them as you do with all of our customers. And I'm going to guess this particular customer was in her 30s to 40s. I don't honestly know. I have no idea. And I'm not a very good judge of age because I'm kind of old myself, but first time home buyer, right? And the age of the average first time home buyer is getting later and later, right? Prices are not coming down. The first time home buyer market is dead, at least in New Jersey, as an asset class. So how does a lender determine what somebody qualifies for in terms of a loan? Like, what can a buyer expect to learn?
So for qualifying for a home,
for a loan,
I mean,
how much
yeah,
do you determine? Like, how do you determine how much of a loan somebody qualifies for?
so we look at income, assets, and credit. And I would say the most important thing is once we get that core three, then we should go through the loan with the client and just go through what their payment, what they're comfortable paying, and go over the closing costs. I mean, a good loan officer will go through the different ideal scenarios and go through the closing costs, make sure that the buyer is as educated as possible.
Right.
At least that's what I try to do.
How do you have the conversation with a buyer who can afford, a $1.5 million house, and you're looking at all their stuff and you're saying, you should really stay about $1 million. How do you as the loan officer handle that conversation? Because I know you do, right? But
all the time, yeah.
Like, you can afford X, but no, I'm going to tell you should probably stay around here, right? And by the way, I'm asking you that question because I know you do that, which is what you should do as a loan officer.
Yeah.
And there's loan officers who said they push their people to the max, which you shouldn't do.
No. And I would say that, as a loan officer, as we should, everybody wants to know what they can afford. So if the conversation we talk about is, hey, this is what you can afford. However, and it goes back to monthly payment. It goes back because again, we qualify based on gross income, not net. So, and had a buyer that we closed. It was one of your clients who wanted me to qualify him or the family on his net minus his other expenses, which was the right thing to do.
Smart.
Yeah, which is smart.
That's called life.
Yeah, because he qualified for way more, but after going through, because
I have I have that. I'm putting money in my kid's college savings account.
Yep.
I'm helping grandma with the lake house, whatever.
Yeah.
And there are loan officers out there who just I have watched them over the years, and you're almost incredulous. Like they're like, you got, and they push these people towards their maximum loan amounts. I'm like, that's not the job. The job is to get them in a comfortable space in the right house with a very comfortable payment, because we don't know when rates are coming down, and so it's sort of like, it's,
and we don't want, and so Jim Marchese, the CEO of Mortgage Now, he definitely, he coaches us a lot and guides us. I learned a ton, from him, and we never want to put our buyers in a bad financial position, because we're lending them the money. We want them to afford the house and not default. So it's in our best interest as well to, qualify them, but also make sure that they're comfortable with the monthly payment, but that they can also make it.
Yeah, so, this is a long-term deal. It's sort of like, here's what buyers should never count on, right? Appreciation and the ability to refinance within 3 years of closing on your property. Like, count on the property not going up a single penny, and count on holding this loan for 7 to 10 years, because that's the norm. We just have lived in kind of crazy times.
Yeah.
Right.
Yeah.
So when you look at the norm of the 30-year fixed rate, we're sitting on it. It's 6.5, right? Like
it's been
just sort of normal, right? So just kind of plan on that number for the rest of your life. Yeah. And, it takes a smart, intelligent human being like yourself to be like, no, dude, don't buy the 2 million. But, if I were you, I'd buy the $1 million, because here's the payment, here's why. And let's look at your net income and factor it out. So I think that's a really important thing. And I think it gets sort of like the euphoria of buying. Oh, I can afford this. Great. No, not necessarily.
What it's the right thing to do as well.
What if your insurance goes up?
Yep.
The only thing fixed is the mortgage payment.
Sure.
Taxes are going to go up. Your insurance costs are going to go up. All those other things. So
Yep.
let's talk about what I find incredible in 2026 in the era of AI, Google search, traditional Google search, social media, 10 billion streams of communication, of which you and I are participating in right now.
Yeah.
We still hear from buyers. Don't I need 20% down? You're like, wait, man.
Yeah.
Really? So
no, you're right.
The answer is no. I'm a buyer, right? I'm a buyer.
Yeah.
What are my down payment options? And let's just pretend we're in Mercer County. Let's forget the other counties, but let's pretend I'm in Mercer County.
Sure. So for you don't have to put 20% down. I mean, honestly, you could put down as little as for FHA 3.5%.
So let's just play this out.
Sure.
You're a first-time home buyer, right? You're going to buy a house.
Yeah.
And you want the asset. You're going to commit to it. You're going to live in it. It's a comfortable payment.
Sure.
You do not need 20% down. You can buy it for 3.5% down. It's an FHA loan. It's one of the best loans you can get, right?
Yeah. And rates are generally rates
are good.
Better,
right?
With FHA. Yeah.
And let's pretend I'm a first-time home buyer, and this is what I wish all first-time home buyers would do. I'm going to buy a 3-family with an FHA loan. How much do I need to put down on a 3-family with an FHA loan?
For a 3-family, okay.
It's like 5%, just so you know.
Yeah, it's 5%. I was going to say chat can fact check me on that. Yeah.
So think about that, right? I'm a first-time home buyer. I'm going to buy a 3-family home. I'm going to live in one of the units for 2 years, right? And then I'm going to move out. I'm going to rent that unit. Now I'm renting 3 units. And then I'm going to repeat the process. I'm going to, and you can, if you're willing to do that a few times, at the end of 10 years, you can have 3 or 4 3-family homes that you own are part of your income, right? Because, that first house you're buying with 3.5% down, it's not the last one you're buying, right? The era of buying that house and living in it forever.
Yeah.
I don't know. Like, it doesn't seem to be the case anymore. Like, people are sort of buying a house and moving around.
Yeah.
Especially in this area,
Yeah, I mean, it's tough. I personally haven't come across any first-time home buyers that have purchased a 3-family.
They all should, Jonathan.
They should. Yeah, they should.
They should.
Yeah.
So first time a buyer can do FHA 3% down. What are other down payment options for a buyer? 5%?
You can go conventional 5%. I mean, if you qualify, and mainly, I think this is mainly for first-time home buyers. But if you qualify, you can even go 3% conventional. But that's not everybody. You have to qualify for that. So,
right.
I mean, you could put down 7%. You could put down,
put down 12% if you want.
12% if you want. Yep.
Yeah. So everyone's got this real, I don't know, like it's one of those like compelling and long running urban myths. I need 20% down. You're like, do you not own a smartphone? Like, really? Like,
you don't have. You don't have to. And there's a lot of buyers that, that think 20% down, but if they did put 20% down, they're wiping out, their
cash.
So so sometimes it makes sense to put down 15 or even 10% down, keep cash, and refi later.
Eventually refi later, or just have a comfortable payment where you're saving money every month and replenish your cash. You don't want to live hand to mouth in the real estate space, right? As a homeowner, you just don't want to do it.
No.
So let's talk about PMI. So what does PMI stand for? Like, what does it mean in the mortgage space?
It's private mortgage insurance.
So why would I have to have that if I'm a buyer?
So generally, if you put less than 20% down, you'll have PMI. So or mortgage insurance. So PMI is for for conventional loans if you put less than 20% down. FHA is different. It's built in. And it's there. I mean, it's there basically because if you put less than 20% down, lenders want that additional insurance because it's considered quote unquote riskier, I guess you could say.
Let's explain why it's risky, right?
Yep. Yeah.
So forget Mercer County, right? Because the FHA limit in Mercer County is very low. Let's go to Somerset County, right? So the FHA limit in Somerset County, you can buy more or less a $900,000 asset, give or take, with 3.5% down, right?
Yeah. Yep.
And people are like, I can do that. You can. Should you is a different question, but you can.
Yes.
Right.
Yeah. Yep.
So what happened in 2010, right, in Somerset County, not Mercer County, it's interesting.
Okay.
Right. The Great Recession comes. Okay.
Okay.
Home prices dropped 10%. I just bought in Somerset County the year before with a 3.5% down payment. Well, now my house, like I'm underwater, that 7% difference. You know what I mean?
Yeah. Yes.
Now when I go to sell it, I bought it for 900. The value went down 10%. I only put 3.5% down. So when I go to sell it, now I have to make up the difference.
Yes.
Right? And that's the risk factor of a lower down payment loan, right? Which is why you want to be very conservative with your monthly payment. God forbid a spouse should lose their job. All those different factors.
Yes.
You know? I was with a client today. She's leaving Princeton, moving to Florida. The firm she's with in the medical space closed, and she has a job opportunity in Florida. But she said, look, I have a huge capital position in this house. When I bought it, I put a lot of money down because I didn't want to worry about like selling it later. I'm like, great. So she's going to rent it for a couple of years and then sell it. So, you know, like having a larger down payment protects you against those fluctuations in the value of the market. And real estate markets don't always go up. Just so you know, ask condo owners in Miami, like what's happening right now, right?
Yeah.
You know, they're getting hammered, you know?
Yeah.
So
and
Austin,
and
Texas, condo owners in Austin, Texas, hammered on valuations right now.
Well, the whole thing with the condos in Miami, now that it made just purchasing a condo in the United States just
difficult, right? And again,
it's
funny.
Sure.
I predicted that was going to happen. When those poor people were hurt in that tower collapse.
Yeah.
I said, this is going to change the entire market. And then Florida started it and said, look, capital reserves, insurance, improvements, structural.
Yeah.
And all of a sudden, all these condo associations who were managed by this dude who lived in the condo for 40 years, they had $500 in the account. They had to go to every homeowner and be like, look, pony up $40,000 each. We're going to put you on a payment plan. And everyone's like, what the hell? But that's what happened, right?
Yeah.
I live in a townhouse myself, and I was talking to the HOA manager, and the property management company that was managing it was borderline negligent. And he's like, look, we have to step through all these repairs over time. Otherwise, we're hitting the residents with an assessment. So like, that's the risk reward of living in a planned community, you know?
It is. Yeah.
So let's talk about credit, right?
Sure.
Credit. Like this is a big deal. And a lot of things go into credit.
Yep.
And I don't think, I mean, I know like in Princeton High School, my kids went through, they took like the home economics version of personal finance, but I don't think it was like, the kids just don't give a crap because, you know, mom and dad are paying, like whatever, like they're not worrying about applying for a loan and credit. I just had a customer, he's a PhD, just got his PhD from Berkeley. He's moving to the East Coast. Okay. And he goes, this is a true story. I was on the phone the other day, right? And he's going to rent on the East Coast. He goes, you know, I don't have great credit. He goes, I have a really good job, but I don't have great credit. He goes, I've been living in student housing for 10 years. I just didn't care. And I'm like, oh my God. So, you know, let's talk about credit. How does a buyer's credit affect their ability to qualify, affect their interest rate, and affect their loan options?
So, so the credit does, and there's different tiers, and every buyer, every buyer is situational, but you know, credit's important, but the credit history is also important. And I'll just give you a general example. So you can qualify credit-wise for a home, but let's say you had a few late payments on your current mortgage. Now, that's an issue. Credit is important. I mean, we lend down to 560 credit. And one of the other things that we do for our clients is, and it does happen pretty consistently, is if we do rapid rescores. So, we'll run, because you have to run credit, right, to get the client's liabilities, also see what their credit is to put a rate together. But we also look at what they can improve if they can. And, that could potentially change the rate, for the better. So like if they're
pay off your credit card.
And we go through that. Hey, if you pay this much, your credit has a chance. And again, nothing is definite, but it's a good guide. Hey, if you pay this off, your credit will jump 15 points. And again, it's not guaranteed, but it's a good measure.
Okay.
So that's what we do. So yeah.
So the higher the credit, the better the rate, right?
Yeah.
Basically.
Yeah.
So pay your bills on time. Don't overspend. Pay your credit cards off every month.
Keep the utilization down. Yep.
Keep the utilization down. I mean, there's some people who, like they're like one of my business partners. She puts everything on a card because she's an expat, and she flies back and forth to Europe, right? So she gets her points. It's what everyone's got a different thing in life, but let's talk about, you just applied for a mortgage.
Mm-hmm.
You're 6 weeks away from closing on a house. What are some things you should not do? Don't go to Home Depot and open a credit card.
Okay. Yeah. Well, no, it's okay. So what you shouldn't do, don't buy a new car. Like, don't finance a new car. Don't open a credit card. Don't put anything on credit. Don't change your job. So what I mean by this is, before you do any of this, talk to your loan officer first, and say you have to, because letting us know I don't know how good of an analogy this is, but you want to tell your lawyer, if you're in trouble, you want to tell your lawyer everything so they know how to help you. In this case, you have to tell us, are you going, I'm thinking of buying a car. I closed on a buyer. He had to buy a car. His car died. So, and again, this is a specific situation. So I asked him how much, his credit was fine. I said, how much is your payment? His payment was actually the same as what his other car payment was. So I said, it ended up working out. But the good thing is he asked first before he did it, just to make sure, because he was in the middle of a transaction. I mean,
don't open a credit card. Don't get a car payment.
Just
don't go to Home Depot. Don't finance a fridge. Don't do anything that could affect your credit score.
And if you're thinking of it, call your loan officer first.
Right.
Talk
to Jonathan.
Just
talk to Jonathan.
Yeah, exactly. Right. Yeah.
What about closing a credit card? I've never used this credit card. I'm just going to close it. It's 2 weeks before closing.
Yeah. Okay. So what's cool about this job is I learn new things every day, right? Because I want to learn every nuance of this. So I'm learning don't close a credit card, because that could hurt. That could potentially hurt.
Which is counterintuitive.
It could lower your credit. Yeah, exactly. And even sometimes paying off your credit card completely can also, I'm doing a transaction right now where I check with we use a third-party credit company, and they had to pay down their one of their credit cards to jump their credit up. Not pay it off. Pay it off would hurt. Pay it down.
But think about that, right? So
completely
counterintuitive. I don't use a credit card. I'm going to close it. That's the safe thing to do. Don't do that. But also don't open a new credit card.
Definitely don't.
Here's what you do.
Don't do that. Don't do that.
During the home purchase process, right? Between when you start looking and when to the day that you close, right?
Yep.
Keep Jonathan on speed dial and say, "Hey, Jonathan, I'm at Home Depot. Can I get a new fridge?" And you'll go to the computer. No, don't get the fridge. You can get the fridge if it's under, but you have to be that careful because, crazy things can happen. Actually, one of my closest friends, right? We've been friends since we were little kids. He's a doctor. He was buying his first house. He was just getting his residency and he was doing the doctor's loan, and, but a week before the closing, the loan officer calls me up. He's very upset. He's like, because this is one of my closest friends, like nothing can go wrong there, And he goes, what happened with this file? And I'm like, that's crazy, And so what happened was like 2 years before, believe it or not, his car was stolen and they never found it. When they found it? A week before the closing.
No.
Right. And it popped up on all, all the stuff. So we were like, holy cow. The loan officer actually we had to go to the police and, he was doing his residency in Newark and we had to get the police report and we had to get the explanation. And the insurance company's like, this is no problem. This is a closed, as far as we're concerned, it's a closed file. Yeah. But it popped up in some chop shop that the cops raided 2 years later. And, so the craziest things can happen. Stay attached to your loan officer. Keep Jonathan on speed dial the entire time that you're in the loan process. Yeah. So let's talk about the bait and switch that happens in the mortgage industry. I took some heat last night on social media because I said there are brokerages who I've not named that I don't think have the consumer's interest at heart. They don't like to put houses on the market. They'd rather double-sided internally make 2 commissions versus netting the seller the most money in the market, right? Whatever, that's your standard practice. That's great. Awesome. Banks kind of do the same thing. It's a bait and switch. They say, come to us. We're going to give you a 5.9% interest rate. And the buyer's like, wow, that's great. 5.9%. I'm going to go to, Banana Bank. And then when they close and we look at the closing document, they got 5.9%, but they paid points, they had all these little junk fees that added up to $15,000 out of pocket at the closing. And they got 5.9 versus 6.374, but it cost them $24,000 at the closing table. And you're like, how does this happen?
It's a lot. Yeah,
I know that. And I know one of the beautiful parts about the way you guys run your business, it's so clean.
Yeah.
There's none of these junky fees and everything else. So, what should the buyer beware of when they're shopping for a rate?
Yeah. So the biggest thing and the first thing is whenever anyone, myself included, gives a rate, that's the rate it's not locked. That's a rate for the day. Now, how you go about that is different. I try to be we try to be as transparent, honest as possible. I mean, sometimes to a fault, losing business, but the rate is going to be for that day until it is locked. So unless you have a contract, unless you're under contract, the whatever rate is quoted is honestly, it could be whatever. Now, also with that, it's important to have all of the entire loan structure. So there are lenders out there that will give a worksheet, not an actual true loan estimate, but a worksheet, and it may not have everything in there. So I'm not saying that they're intentionally being deceptive,
I am saying that they are, because I'm saying,
okay, I don't
look, there's doctors who go to jail too, right? It just, there's every industry Every
Yeah.
industry has,
Yeah.
you know, better or worse. It just is what it is. So it's like
It is. Yeah.
what you're saying is, and what the industry standard is, not the standard, but there's a practice in the mortgage industry.
Yep.
They'll say, look, this is what we think your fees will be. And it's a mortgage
Yeah.
sheet versus a complete documentation of every possible scenario that if you close this loan, this is what you're going to pay at the closing. This is your title expense. This is, which is more or less state regulated, right? But,
Yeah.
And what you guys do is the opposite. You're like, no. This is everything included, right?
Yeah.
And I know a lot of lenders just don't like to do that because they don't want to like raise the curtain.
Raise the curtain. Yeah, it could be that. Yeah, it could be not wanting to collect all the documents up front. It may, they may not. I don't know.
Let's pause there for a minute. Let's pause there.
Okay.
Because dear God in heaven, right?
Oh, yeah.
I'm a loan officer. You're a buyer.
Mm-hmm.
And I pre-approve you. And
sure.
Look, most pre-approvals are verbal. I make X.
Yeah.
And my liabilities, my car payment, whatever, is Y. And loan officers will take that, put it in the computer, and give a pre-approval sheet. Why is it important for the buyer to take time out of their day and their week? And I know that it sucks because it's 8:15 at night. I'm still at the office, right? I have 2 hours worth of work to do after we get off this call. Why is it important for a buyer to get all their shit together and get you all their stuff at the outset of this process? Which I know you do.
Yeah. So if they're serious about buying a home, well, number one, it's going to give the loan officer, us, the ability to give them, as accurate as possible the numbers. That's number one. And then also number two, when we qualify our clients, we do our due diligence up front. We collect. I don't want to give away all of our secrets.
But we get all the information in front, and
we get everything
honestly,
up front.
It's kind of a pain in the ass for the consumer today. It's not a pain in the ass when they close with no points and no fees and no gimmicks and no BS. Or I love the call when the buyer is so smart and they find the low rate, and then 4 days before the closing, they call me up and so, why am I paying all these fees with this lender? I'm like, because you didn't use Jonathan, dude. Like, you're getting hit with junk fees exactly the way I told you it was going to go. Yeah. Right. Yeah. And, so doing the due diligence up front for the buyer saves them time later, saves them money later, gives them intense clarity on what's going to happen in the mortgage process. And I think most buyers just want to rush through it because uploading files is not sexy.
Well, it's not even that.
It's kind of boring.
But you could also jeopardize potentially, so we get a lot of our business comes from buyers who are coming from another bank, and they're midway through the process and they're like, the loan's dead. So we get a lot of clients. So another reason to collect everything up front. My colleague Chris Tamayo, who should be watching this right now, he
shout out to Chris.
Shout out to Chris.
Unless you're not watching.
Yeah. Unless you're not watching. But shout out to Chris. He tells the buyers, and I use this. Look, we're going to eventually bother you for the documents. So I'd rather bother you now up front. But what that's doing is we get to look at the employment. We get to look and see, because there's a lot of guidelines that.
So by the way, Chris just chimed in. He's watching. So Chris, you can shout out.
Okay.
If you unplug before the end of the broadcast, I'm taking you back.
Yeah. No, but he did. So, but it's important, and look, it helps us do our job, because when a pre-approval comes from us, and we call them pre-commitments, but when it comes from us, the selling agent knows that they've been fully vetted, and they know that they've been through initial they know that we've done our due diligence, and they don't have to worry about like your buyers, for example. So
right.
Yeah.
Right. So Mortgage Now is an interesting company, and I'll kind of pivot and I'll give Mortgage Now a pitch, or like you guys, when we opened as Queenston in 2021, you and I met, right?
Yeah.
Fairly shortly thereafter, and I'm
It was like
no,
right when I first
it was
started.
pretty good. And you came in with your CEO Jim Marchese,
Yep.
who I've seen literally work miracles for clients. Like, I swear to God,
Yeah. Oh,
go to the board and be like, board, this client, high net worth individual, needs this tomorrow morning at 9:00. And like, I've seen miracle. And it's not like, this is not like a shady borrower. This is a high net worth borrower who is competing against a cash offer, right?
Yeah.
And I've seen Mortgage Now work more or less miracles for the consumer, right? And just good rates, good products, the whole thing. So great bank to work with, great lender, the best lender I've ever worked with, and this guy here. What other things do you guys tell a buyer, like when you're getting that 5.49? What should buyers be wary of? Like,
so there's a few things. If they're getting an unrealistically low rate, I mean, you can Google average, average rate for, a buyer with so-and-so credit, whatever. So number one, you can see that, but also whatever lender is giving them that rate, first of all, should be giving them an estimate, I would say. You need to be upfront with, there could be points. So like, for example, if you see let's say a 5% rate, right? But then you see the APR, and I'm just throwing out numbers. You see an APR of like 6.5. That
it's not real.
It's not real. Well, there's points and other fees involved, a mix of, or it could be
filing
a mix of those.
Fees.
Yeah. So
closing fees.
Exactly. Yeah. So that's one of the things. But they should, if you have a low rate, and you get it from a lender, I would honestly, call me, but
call Jonathan.
You Google it and check, but just find out why.
Yeah, and it's funny, like when we interviewed together the first time, I was kind of like, I'm good. Like, I have a system, I have a process, and it's a good process. I have a good loan officer we've partnered with. And what we felt was lacking a little bit was the response time, right? And I said, right, like I said, the most important thing is, my client calls you, you pick up the phone. I told you that 7 days a week, 24/7.
Oh yeah. Yep.
We have to be, that is it. Right. And I know there's like a push against the hustle culture right now, but this is a 45-day window of somebody's life where they're making a really large asset purchase. What are we not going to do? Not be available? We're available. That's the gig. If you don't like that gig, get out of the mortgage business, get out of the real estate business. Like, go.
Yes. Yeah.
Go be in the business that doesn't help the customer,
Yeah.
So
I mean,
it's, and then we talked about that. And then, it was after I called you back like a year or two later, and I said, you know what, let's talk again. And then we made the pivot, and, we partnered with you. And like I said, best loan officer I've ever worked in 20 years. I mean that unequivocally. Like,
thank you. Yeah.
And just a great corporate culture where you look at the consumer. I feel like from Jim down, you guys are looking at the consumer through the consumer's eyes in this process, right?
Yes.
It's not like the consumer's not an asset. It's like, we have to partner with these people to get them to where they want to go.
Sure.
And, we have to do everything in our power to get them there, and be honest and be truthful, and, be comfortable, and all of those things. So somebody just said, Jonathan is awesome. Just so you know, Kobe Tough. I don't know who Kobe Tough is, but that's your boy, Chris. So Chris, you get a second shout out for complimenting Jonathan. So
thank you.
Let's talk about communication, right? So we meet a buyer.
Yeah.
We have a process. I'm not going to give away the Wilton Group's secrets, right?
Yeah.
Very early in the process, we transition to you for the full assessment, We want all the docs, which, by the way, we as the realtor, we don't know, we'll never know what you make. We don't know your credit. Because that's the blind trust we put in our loan partners, right? Like that's, and there's realtors out there, kind of the old school, like, what does the client make? It's none of my business. Like they don't, if they wanted to tell me that, they would have given me their income, their tax return. They give it to you. I don't want to know. It's none of my business. Don't need to know the credit. I need to know what you're approved for, right?
Yep.
I need to know what the comfortable payment that we're bidding to is.
Yeah.
And that's it.
Yep.
Right. So just, consumers should realize the fact your realtor's not party to your, or should not be party to your financials. Yeah. How often, once a contract is accepted and you write the loan, how often are you talking to the customer from that point to closing?
Oh, geez. Okay. Well,
other than
with the client,
we can do A, B, C, or D. A 10 times a day, B 20 times a day, right?
So it could be multiple times a day. It could be once a day. No, it's not once a day. And by we, meaning I'm communicating with the client. A processing team is communicating with the client.
Underwriting.
So we're,
as you get closer, your closers, like everybody.
Exactly. Yeah. And I mean, that's probably the most important communication. And I come from the real estate side. So, I'm operating and we operate as a company. We operate, with, I would say there is a sense of urgency, but we operate as if the client were the client. Like it's a nice, I think it's a nice lens of the process where you guys really, I don't know, like you really have an amazing approach to client intake, client management. Now, I will say, like, let's when one of the things that I think that makes your process better is the insistence up front of what you said. Bother you now, bother you later. If I bother you now, which I'm going to do, because we don't want to work with clients unless you have all completely vetted them, right? Yeah. That makes that 45-day window from contract to closing so much better, right? Or shorter than that.
And even shorter. Like we can close theoretically close faster. We like to budget 45 days.
Sure.
But theoretically we can close a little faster. But like,
of course,
it's sort of like the earlier that you can partner with Jonathan in the process, get him your full docs, get the full financial workup, understand your loan options, understand your payment, get everything ready to go, get the mortgage pre-commitment, right? Which is what you guys issue. Because what people don't realize, Jonathan and his team don't issue pre-approvals. You want to explain the difference between what you do and a pre-approval?
Yeah.
Because this took, when I first met you, I was like,
without giving away
too much,
all of our secret, too much.
And Jim will get mad at us.
So the difference between our pre-commitments and so far, I don't know another lender that does what we do. The difference is we already been through underwriting, basically, initial underwriting. So when we put out our pre-commitments, I mean, let's just say the terms are, our pre-commitments compete with cash offers. That's what I'll say.
That's fair. And that's all we're going to say, because
and it compares it, and
the vetting process up front is so thorough, right?
Yeah. Yep.
And in Mercer County, when you're in a high demand, low inventory environment,
sure, that's
40% of Princeton's cash, 20% plus of West Windsor, 20% of Plainsboro, 20% of Montgomery's cash.
Yeah.
The probability of you competing against cash in any of those market segments is high. Lawrenceville, Hamilton's a little bit less. Like when you get a little southward, it's less. Cranberry, it's very high. Big cash market in Cranberry. Not a lot of transactions, but a big cash market. So like having your ducks in a row is incredible, right? Like it makes the process better. And then as a buyer, you're making a clear bid, right? We have our trade secrets on how we look at the market and how we do our thing, which we're not going to give away either. You have your trade secrets. I will say it makes a very potent combination on behalf of the consumer because they're approaching this with total clarity on the market and the financials to make a clear decision. And confident, clear thinkers win bids.
Oh,
the end.
For sure.
Yeah.
And I'll say one more thing about our pre-commitments too. So a buyer that puts less than 20% down with our pre-commitment is just as strong or not or maybe stronger than somebody who's putting 25% down, because we've already went through everything. So even though they're putting the 10% down, for example, they're good. So that's another thing as well is, on the realtor side, the misconception, oh, I have an offer that's 20% down, but then I have mortgage now that's 10% down. Our 10% down is just as strong, if not strong.
Right. Because they're vetted. They're completely
they're good. Yeah.
And it's funny, like as a listing agent, right? I always call the lender of the buyer. And I want to know, did you check their tax returns? 99% of the time, they're like, no. I'm like,
you're right. No, you're right.
Like,
a lot don't.
There's a list of questions I ask every lender, and 8 out of 9, they're like, no, we just did a pre-approval. I'm like, well, all right. And if it's the best offer, we'll give that buyer a chance to go back and get cleaned up. But at that point, I may have 3 other offers waiting, right?
Yep.
So it's just, we're not going to give you bilateral control of the house after attorney review without clean financials. And that's what's at stake, right? So when you're a buyer in the state of New Jersey, you come out of the attorney review period, right? You put your money in escrow.
Yep.
You have a equity position in that property. You don't own it yet, but you put 5% down. The seller cannot do anything with their house until you either close or that deal terminates. Could be 30 days, could be 40 days, could be 60 days. Right? So think about it from the seller's perspective. What they should want to see is completely clear financials, because they're taking an average in Princeton of $1.9 million asset off the market if it's a mortgage, right? And imagine the lender hasn't run the tax returns, and imagine the listing agent doesn't know to ask these 10 questions of the buyer's lender.
Sure. Yeah.
Right. Now they've taken this $1.9 million asset off the market and the financials are not vetted. I can tell you with Mortgage Now, I know they're vetted, which is one of the reasons we partnered with you, because you make the process easier for us and the consumer,
Yeah.
So let's talk about refinancing, right? Everyone's waiting.
Sure.
And
we are too. Everyone.
Everyone's waiting. It's not going to happen anytime soon, right?
Yep.
When does refinancing make sense, right? And again, I hate marry the house date rate. It's just so insulting. Plan on having this rate for at least 10 to 15 years. If you can't afford the payment, buy lower, right? But now rates have come down, right?
Sure.
I bought at 6.5. Rates go to 6.25. Is it worth it to refinance?
Okay, so the breakdown in what we do, and this actually goes with it's the same concept of paying points versus not paying points. But I mean, the simple answer is when the benefit of refinancing outweighs like the cost of doing it. So, and then the timing of it. So like, for example, if your refinance costs, let's say $6,000 closing, current mortgage payment is $3,500. If you refi, new mortgage payment is $3,200. So $300 in savings, right? The cost
is $6,000.
$6,000, and then you just divide that by 300. So 20 months. So it's going to take you 20 months to recoup that. Is it likely that you're going to refinance before 20 months? Probably not. Well, I don't know. So
what's the rate? Like, what's a good rate differential? I buy at 6.5. Is it 6? Is it 5.9? Is it 5.8? Is it 5.7?
I mean, I every borrower is different, but I would say generally 3/4 of a point to a point. But sometimes, honestly, sometimes for some borrowers, it makes sense
There's always
It depends,
the
but
exceptions.
let's say
let's just say 3/4
let's
of
say
a point is the average.
3/4 of a point to a point.
Okay,
Yeah.
so we'll just say 3/4 point to a point. So 5.75 to 5.5.
Yeah.
So when that happens, borrowers should go, wow, we should call Jonathan to refinance this rate.
Yeah, or we'll probably call you first, but yeah.
Yeah, fair enough. Yeah,
but you
it
call.
should be top of, like, when you're, we're all,
course.
like I said, we're all professional. We all work for the Federal Reserve in our mind, so we all think we're going to impact rates by watching.
Oh yeah, no, but call people. And if you're not sure, call. Hey,
What's the scenario? Let's run the math.
Yeah, run the math. Yeah, absolutely.
Okay, awesome.
Yeah.
So how do people find you, Jonathan? So, like, where are you on social? Like,
I need to pick up my social media game. But
what's your handle?
Instagram. It's Homes by John Brunone on Instagram and Facebook.
Homes by John Brunone on Instagram.
Yep. Yeah, JON. No H.
Right, JON.
Yeah.
So, and we're going to tag you in the post.
Okay.
When we post to social. Let's wrap it up. If anybody has questions, obviously, please put them in the chat.
Yeah.
But let's talk about buyers who are going to buy in the spring, because now we're getting ready. The fall market's busy as always.
Sure.
But the spring is the season, right?
Mm-hmm.
Top 5 things a buyer should do to get ready for the spring market.
Well, I could talk to your lender. Talk to me. Yes. Yes. Talk to me.
You're so self-effacing.
I know. Sorry.
There are no other lenders.
There isn't. No.
You ever watch Rocky? There is no tomorrow. There is no other lender.
Yes. Yeah. That is true. So yeah, talk to me as soon as possible, because you want to make sure you have everything ready. Like, work on your credit card utilization. So there are steps to make sure you're fully prepared, to buy in the spring. And look, it's even better because what if you see something beforehand? I mean, the winter time
basically
has less competition, right?
Right. So it's like, let's say, we're gonna move next spring with the kids and the schools and all the other stuff.
Yep.
They should get you this year's financial documents, or they should get you 2025 now, right?
Yeah.
Do work up in 2025. They close the books on 2026. They get you the financials for 2026.
Yep.
They are the most bulletproof, market-ready buyers that are going to be known in the market, right?
Yeah.
So it's all, I think, at being a good buyer, it's all about the pre-work. So, like, we had a meeting today, right, with a new buyer. Like I said, first-time home buyer age is definitely older, and not in a bad way. It just is what it is from a market perspective.
No, it is.
And then, she had a meeting with it. She's interviewing realtors to buy, right? She wants to buy in Princeton. And, they just had a conversation. We went through data and process and market and all the other stuff. And immediately at the end of the call, we're like, you need to talk to, next step, you have to talk to Jonathan.
Yeah.
And she's like, well, I'm not 100% convinced I'm going to buy in New Jersey. I'm like, I don't care if you buy in New Jersey or not. It's to be ready to buy in New Jersey. You got to talk to this guy. So it's sort of like, we try to do as much work to have the best experience we can with the consumer by helping them up front, putting everything on the shelf until they're ready to buy. And then we can take everything off the shelf on the work that we've done and get them into a house.
Yeah. I mean, because there's so many things that buyers don't think about, which they shouldn't, that could affect their buying power or their ability to buy. Yeah.
So, all right. Well, listen,
it's
late. I know you get up early. I know you have a lot of work to do, because I know my team and I will keep you as busy as we can.
You do. Yeah.
And the fall market is definitely coming our way.
Yeah.
So I feel like the fall market actually started a little bit earlier this year. Like, normally, we don't really get rocking and rolling until Labor Day, but Labor Day is late this year. So I don't know. I feel like the last week or two, it got really busy. And
it did.
For people that are watching, we put in the chat. It's Homes by John Brunone, no H, on Instagram. So you can hook up with this guy on Instagram. And, I just want to thank everybody for tuning in. Jonathan, I want to thank you for coming on the broadcast tonight and chatting about mortgages. And
thanks for having me.
Financing is one of those important parts of the real estate transaction, but it should not begin after you find the home. Let's just kind of reiterate that. And your budget, your loan options, cash requirements, monthly payment, getting that all ahead of time, right?
Yeah.
That is like I said, the informed, smart, confident consumer wins, hands down.
Yeah.
No questions asked. So, if you're watching this and you haven't subscribed on whatever your channel you're watching, you can hit subscribe to that channel. And again, thank you for tuning in. Thank you to my guest, John Brunone, and the Mortgage Now team for being just so awesome to work with. And again, as always, I'm Josh Wilton. This is the Wilton Report, and we will see you guys back here for the next episode. Thank you, everybody.
All right. Thank you. Take care.